Hello, I hope this finds you well. Today is Tuesday, November 17th, and in about 5 minutes or so, I will share with you a brief overview of what happened in the markets last month, as well as what we will be paying close attention to the rest of this year and into 2016. And I will give you a hint: interest rates. But first, let's talk about what happened in the markets last month. October was a great month for stocks. The U.S. stock market, as measured by the S&P 500, had its best monthly return since 2011, up 8.3%. And after a tough third quarter, that rally was definitely welcomed. We believe there were a few reasons why the market rallied in October. Number one, the market is feeling a little bit more comfortable with China. Number two, market-friendly central bank actions helped to prop up the market. And lastly, a relatively good start to the earnings season, as well as a budget deal out of Washington, helped maintain positive sentiment throughout the month. International markets also had a good October, although they did lag behind the U.S. Developed international markets, as measured by the MSCI EFA index, were up 7.8%, and emerging markets, as measured by the MSCI Emerging Markets Index, were up 7.1%. Perhaps the biggest surprise piece of news we got last month in October came from the Fed and the Federal Open Markets Committee, or FOMC, which surprised markets by releasing a somewhat more hawkish statement than expected following its October meeting. Hawkish meaning potential for increasing interest rates sooner rather than later. In the statement, the FOMC removed language about the potential negative impacts of international risks, although it did retain language that they would continue to monitor international developments. Interest rates and Fed fund futures markets, which had substantially pushed back rate hike expectations since a somewhat cautious statement after the September meeting, quickly pulled those expectations forward. The implied probability of a rate hike now in December moved from 30% to 50%, according to Fed fund futures. Interest rates last month increased modestly across the maturity spectrum, with the 10-year Treasury yield rising from 2.06% to 2.16%. Probably the number one question in financial markets over the past few years is, when will the Fed increase interest rates? And based on October's FOMC statement, there is now a larger probability that this could happen in December. So what does that mean for stock and bond markets? The chart I want to share with you this month from JP Morgan's Guide to the Markets shows historical impacts of rate increases, both on the stock as well as the bond markets. So let's take a look. On the top of the page, we see the last 3 rate hike cycles, with Fed funds rate denoted by a white line and the S&P 500 returns shown as a green line. The shaded areas show the period of time from the first rate hike to the last. On the bottom of the page, we see the 10-year Treasury yield denoted by a blue line in place of the S&P 500. In the stock market, in each case, the market fell in the immediate aftermath of the first rate hike. However, by the last rate hike, the market was up, marginally in the 1994 to 95 cycle, and more substantial in the cycles that began in 1999 and 2004. This is evidence that interest rate hikes from low levels are generally not threatening to the stock market. Bond market reactions have been a bit more negative, with 10-year yields rising substantially in the 94 to 95 cycle, although less so in the last 2 episodes of Fed tightening. Remember that bond yields and prices have an inverse relationship. As bond yields increase, bond prices decrease. While history would suggest that rate hikes would be more damaging to the bond market than the stock market, it must be recognized that the fact that rates will be rising from such a low level and so far into this economic expansion makes history a less reliable guide than usual. Bottom line is, whether the Fed increases interest rates in December or next year, it should be viewed as a positive move. What the Fed is telling us is that our economy is on solid footing. The truth is, we are still at emergency levels of interest rates 6 years into this recovery. Expect volatility to increase, but if you are a long-term investor, use that volatility to your advantage. Thank you so much for taking the time to watch this. I hope it was helpful. And as always, if you have any questions, please feel free to give me a call. Take care.